Most options trades are a bet on direction. Up or down. This one isn't. I'm about to buy a structure that makes money when price moves a lot, and it genuinely does not care which way it goes. And here's the honest part up front. I don't know yet if this has an edge. I'm going to paper test it before a real dollar touches it. But it's the best trade I've found for actually feeling how options work, so let me build it up with you and show you exactly where it could fall apart. This is Smart Crypto. I build and test trading systems in public, the real process, dead ends included. Today, a delta-hedged long straddle on Bitcoin. Start with the phrase delta neutral. Delta is just how much your position moves when Bitcoin moves a dollar. Hold one whole Bitcoin, you're plus one delta. Delta neutral means your net delta is about zero. A dollar up or down by itself barely moves your P and L. You've switched the direction, bet off. You build it from two pieces. A call, which pays off if price ends up above a strike, and a put, which pays off if it ends up below. At the money, a call is about plus half a delta, a put about minus half. Hold both and the deltas cancel. Plus a half minus a half, net zero. Buy the call and the put at the same strike and expiry, and their payoffs add into a V. You lose the premium if price just sits on the strike. You make money once it travels far enough in either direction to clear the break-evens. Max loss is the premium you paid. Fully defined. That's the straddle. Owning it, you're holding two forces pulling against each other. Gamma is your friend. As price moves, gamma keeps handing you a delta in the direction it just went. That's the thing you're going to harvest. Theta is your rent. Every day, the options quietly lose value to time decay. That's the cost of holding gamma. Move enough, gamma wins. Sit still, theta bleeds you. That tug-of-war is the entire trade. Here's the active part, and this is the skill worth learning. Watch what happens when I move the price. Push it up, the call's delta grows, the puts fades, and suddenly I'm net long. To get back to neutral, I sell a little perp. Push it down, I go net short, so I buy some perp. Every move, I trade the cheap perpetual to flatten myself back to zero. And notice when I'm trading. Price ran up, I got long, I sold into strength. Price fell back, I got short, I bought into weakness. Sell high, buy low, over and over, funded by the wiggle. Traders call it gamma scalping. Each hedge isn't just risk management. It books a little cash. But remember the rent. I paid theta the whole time. So the real question, the thing this entire trade reduces to, is one number. Did price actually move more than the market charged me for? The premium I paid bakes in implied volatility, how much the market expected it to move. My hedging harvests realized volatility, how much it actually moved. If realized beats implied, I win. If it doesn't, theta bled me and I lose. That's it. A clean, direction-free bet on a single number. Which is where my project comes in, and where I have to be straight with you. I've been building a gamma exposure signal that's basically a short horizon forecast of realized volatility. In the one window I've measured, the high acceleration regime ran realized vol about 1.3 times the quiet regime. So the timing rule writes itself. Signal says a big move is coming, put the straddle on. Signal says quiet, sit out. But that's one small in-sample measurement, taken during a 2.5-week sell-off. No out-of-sample test. The volatility risk premium flips against you in calm markets. So I'm treating this as a learning tool and a hypothesis to test, not an edge. Anyone who tells you their backtest is an edge after one window is selling you something. One more reason I like it as a starting trade. I already killed a four-leg condor idea. It crossed four wide out of the money spreads and just held to expiry. Dead on arrival. The straddle uses the tightest part of the board, the at the money weekly, crosses it only twice, open and close, and does all the repeated hedging on the perp, where the cost is almost nothing. The spread goes from a wall to a headwind. Concretely on live numbers, one Bitcoin straddle runs a couple $100 in premium. That's the whole max loss. $2,000 comfortably funds one, plus the margin to hedge it on the perp. So the plan is simple. Wait for the signal to flag high acceleration. Buy the at-the-money weekly call and put. Hedge the delta on the perp as it drifts. And track the race, gamma booked versus theta paid, until the regime flips or the week ends. And the honest caveats because they matter. Hedging isn't free. Fees and slippage nibble every scalp. Theta is relentless when nothing happens. And every crypto options venue geo-blocks US traders, so access is its own problem. None of that kills it as a way to learn. It just means I treat the P and L as tuition, and let the paper tracker tell me honestly over enough trades whether the signal actually holds up before a real dollar rides on the edge claim. So that's the build. Next, I'm putting up the paper tracker that logs every one of these and answers the real question. Does realized beat implied when my signal says go? I'll show you the results, good or bad. If you want to watch a trading system get tested honestly instead of sold to you, subscribe. That's the whole channel.